Thank you for the introduction, Adam. Over the last 8 to 10 years, climate scenario analysis has emerged as a key tool aimed at helping us understand the impact of climate change on our economies, the environment, and the financial system. Despite its age, climate change scenario analysis is still quite nascent. And banks internationally and domestically continue to develop at different rates. Today, we'd like to discuss briefly the emergence of climate change scenario analysis and its growing importance to the banking system. We do only have 30 minutes, and I'm conscious it's 30 minutes between yourselves and lunch, so we'll try not to take questions from the floor given the size of the panel, but we may as well just jump into it. So, Graham, we might start with you. What is the purpose of climate change scenario analysis, and how does APRA think about it?
So I think John Lonsdale captured it this morning. It's about risk identification. And from that perspective, it sits alongside other tools and systems and techniques around risk identification that exist within entities today. But climate risk is also a little bit different. It has its own language. We talk about physical risk, we talk about transition risk. It has a different time horizon to it. We see already today changes in the likelihood of extreme events, but that is going to continue for a long time into the future. And it's not about the 3-year or 5-year business cycle, it's about out to 2050, 2100, etc. How APRA thinks about it? Well, we set out how we think about it in our 2021 guidance, where we set out our expectations around climate risk. We see it that understanding climate risk is necessary. It's a necessary component of an entity's broader understanding of its risk environment. But that's also not to say that every entity is seeing it the same, or needs to address it in the same way. So, large complex entities, we have an expectation that there will be an analytical capability that's appropriate for understanding the issue. For smaller, less complex entities, then this might be a narrative-driven discussion. It might be a more qualitative discussion. Lifting it up a little bit though, we see climate scenario analysis and climate risk more generally as a supervision priority for APRA. The learnings that we receive from the banking climate vulnerability assessment, we're using that in supervision uplift, we're using it in entity engagement, and we're using it in thinking about new analytical initiatives. And so, yeah, our work continues in this space.
And you touched on physical risk and transition risk. Perhaps we can unpack that a little bit more, and I might pose the question to Alex. What is physical risk, and more importantly, how does it actually manifest in banking?
So, thanks, Andrew. That's a very broad term, physical risk, but in the context of climate scenario analysis, it really refers to 2 broad types, which is acute physical risk, things like storms, cyclones, floods, bushfires, things we've actually experienced, and has some impact already being felt in majority by the insurance industries and also governments that have acted as shock absorbers. And then I think more emerging type risks such as sea level rise and even heat stress or even sometimes droughts that have been more like, are linked with chronic physical risks. So as I mentioned before, I think the loss pathways on a relative basis is more well understood in terms of the losses to lives, livelihoods, and also the economic impacts or insurance impacts. What's less well understood is how that then flows on into credit risk, liquidity risk, and others, and even market risk types. So that's a newer area that is just starting to be unpacked at the moment.
And perhaps I can ask a similar question to Mark, but if you're able to focus more on transition risk that Graham touched on.
Absolutely, thanks Andrew, and good afternoon everyone. Not that I can see you with these lights. So transition risks first and foremost, so it's the risk that relates to the pace and I suppose the extent to which either an entity, a sector or an asset can adapt to the changes that's going to occur in the world as we try to get over managing climate risk. So in climate scenario analysis, banks really try and consider, how their customers might change so that they're not more exposed to climate risk, for example. And they think about that through the lens of today, but also in the future as well. So once we've done some analysis, we want to use it as an input to drive risk management. We might want to use it to drive strategic planning, target setting, potentially even product pricing and product eligibility. So banks' assessments typically for transition risk can either come in the form of top-down assessments or bottom-up assessments. And I'll just unpack both of those kind of briefly for you. So top-down assessments tend to be looking at industry sectors. And normally what you're trying to do is rank order those industry sectors, which is better than the other in a given scenario. Sometimes this might be in the form of gross value add per sector, which was one of the facets that we saw in the CVA. Sometimes this might also involve, a definition of policy or a carbon tax over time. Banks then try and assess their exposures over time using either a static or a dynamic balance sheet. And they want to look at how that change in sector performance will then affect their balance sheet. And this can derive insights about the makeup of their portfolio over time. So, for example, you can then feed it into strategic decisions that you might want to make to improve your performance in a certain metric or to adhere to a certain target. There's also bottom-up assessments, as I mentioned. So these can be conducted, at a customer level, and also they can focus on case studies, for example. So the case studies that I've seen are where there's a significant concentration in a location, perhaps it's sort of a single industry town, and hypothetically you can look at what happens if that significant business was to exit and the impact that would have. Now there's two lenses to project the impact if you're a bank. One is on the wholesale customers, so the business that exits, the regional location might itself be a customer. There's going to be an impact there. But there's also going to be indirect impacts as well on local services and other knock-on impacts to other local businesses. But then there's retail customers in that area as well. You might increase unemployment. You might have indirect impacts on services, which means that it's a worse place to live. And this could even put downward pressure on house prices. So sometimes by unpacking all of those various impacts, a bank can learn more about what could happen and then be able to think through their strategic planning or risk management. So there's also customer level assessments that I mentioned from a bottom up, which can focus on the robustness of a customer's transition through their financial strength, but also through any specified scenarios. So financial strength can be a good indicator of the ability to transition, as well as the resilience to any transition that you have. The last thing that banks often look at is retail-driven transition risk assessments. Now, given time, I won't go into detail on that because they are less prevalent, but if anyone wants to chat over lunch, I can bore you about energy performance certificates in the UK or why my experience of Australian houses are that they're made of paper in winter.
That's right, it does deserve a round of applause. Taking an upper level, Paul, perhaps I'd be interested in your views on the current state of maturity of climate scenario analysis and perhaps looking through a lens of internationally and then domestically.
Yeah, I mean, climate modelling is nothing new for many, right? It's been around for decades. I think when bringing that down for scenario analysis for banking, it's at a very early stage and where we're at in terms of development and in terms of accuracy as well. But in saying that as well, from a global perspective, there are other regions which were early adopters compared to Australia. So I won't touch upon all, but I'll kind of reference kind of more the leading areas which were early adopters, like the UK and Europe. The Bank of England, for example, were one of the first areas or institutions to bring on board globally climate risk requirements, which obviously encapsulated climate change through analysis, and then the ECB as well. And secondly, they have mandatory requirements coming in live as well, which also capture climate change through analysis. Now, you would like to think that because they were early adopters, they would be a lot further ahead as a result. Now, in some aspects, they are. So being early adopters, they've been able to better themselves in capability uplift. They've established an array of different working groups, both within banking industries and insurance industries as well. And second and thirdly as well, there's a lot of kind of online tools and supporting resources that are being put together, to help banks and other financial institutions to obviously get themselves up to speed in terms of capability, training, and knowledge base around these scenarios, which then touch upon what's just been touched upon here from a physical and transitional risk. Domestically, Australia, it was quite funny because I came back from the UK at the start of 2021, and it was a bit of a shock because they had started their journey quite a few years ago. For example, they had done their climate stress testing. For example, in the UK, they did insurance as far back as 2018 and banking in 2021, and the ECB have done various exercises, both supervisory and industry-wide as well. Whereas coming back into Australia, it was a bit of a shock because it was a little bit of a step back in terms of where they were at. But fast forward, since arriving here, the pickup has been enormous, right? And that's been for various reasons. Dr. Chalmers spoke about it this morning across consultations across climate risk disclosures, which includes scenario analysis. And even the regulatory bodies as well touched upon, the importance of that. And I think secondly as well, Australia is not immune to climate variability, right? We've been experiencing this for a very, very long time. So across the industry, and not banking, but broader industry, there are a lot of very good heads that have been capturing this. Where we're kind of at the nexus is in taking that on board into the banking industry and translating that into a metric which is more kind of consumable and what we kind of report on as a result. And this is where, while we're all at an early infancy stage, it's an early journey at the end of the day, and it's very complex as well. Don't forget, we're no longer going out from 3 to 5 years now, we're going out 10, 20, 30, 50, out to 2100. So it's a little bit more complex. It's hard to kind of get a level of accuracy around that, and it's important to highlight that these aren't at the end of the day forecasts, right? They're exploratory, and they're supposed to be used as guide points to kind of understand potential sensitivities around our balance sheets.
Thanks, Paul. Uncertainty is one of those areas that tends to come up a lot when dealing with climate scenario analysis, and I'd like to spend a few minutes just to unpack that, perhaps starting with Graham from a regulatory lens, and then I'll ask Alex to also respond from an industry point of view.
So when we published the results of the climate vulnerability assessment, we spoke about challenges in data quality and accessibility of data. And I think you could add to that list uncertainty in climate scenario analysis. But I think we need to separate out a couple of things here. So climate scenario analysis, there are climate models, there's scenario analysis, and they come together. And we should acknowledge that climate models have uncertainty associated with them. We don't fully understand ocean-atmosphere coupling, though Alex may well and can probably talk to it. We don't precisely know what technologies are going to come in the future, what their cost is going to be, how rapidly they can be scaled, what the economic circumstances that they'll be deployed in. We're not exactly sure just how that future is going to evolve. But this is not unique to climate and climate modelling, and I think that's something that we need to recognise and get comfortable with. On Monday, the ASX, I looked at their rate tracker for the official cash rate, and the prediction was 67% that the RBA would hold rates constant. That didn't quite play out, but that doesn't mean that we throw out interest rate forecasting and say it's impossible, it can't be done, it's all too uncertain. I think along the same lines, we could also probably acknowledge that for decades, climate models have been saying, well, if you increase the emissions concentration of greenhouse gases in the atmosphere, you get higher global average temperatures. And, you know, history has shown those models were both directionally correct and quantitatively pretty accurate. So that's the piece on the climate models themselves. On scenario analysis, it is a little bit different, I think. So climate models are part of scenario analysis when we're doing climate scenario analysis. And there are other aspects that feed into that which have some uncertainty about them as well. But there's also aspects which are extremely well known. So when we worked with the 5 large banks on the climate vulnerability assessment, we provided an emissions trajectory for each of the 2 scenarios that we worked with, and a GDP expectation for them as well, and amongst other things. Well, there was no uncertainty about that. That's what those scenarios were. And I think that really sort of underlines the point that we get to choose the scenarios, and I'm going to quote from the guidance that we published, to make them plausible and relevant to the institution's operations. It doesn't mean that there's no uncertainty there, but they're plausible and relevant. And in that light, to me, it's not, the focus here shouldn't be around uncertainty undermining the value of climate scenario analysis. It's really about how does scenario definition maximise value and insight for the institutions as they're doing the work.
Alex?
Yeah, thanks, Graham, and totally agree in terms of at least the scenario part, like, you know, defining those scenarios. But I think if you take a broader view, it starts in climate modelling, particularly physical climate modelling, all the way down into scenario analysis applications. It starts with scenario uncertainty, which Graham has spoken about, providing, let's say, a social economic future. Is it the RCP, let's say 8.5, or hothouse world, depending on which scenarios you take, or is it a more positive or optimistic future where everyone gets to net zero, right? And that will also inform, you know, the physical outcomes therein. However, from that scenario uncertainty, it branches into model uncertainty and then inherent internal variability, which Paul touched upon earlier, which I'll get to a bit later. But with model uncertainty, it really starts from, okay, so we've released all that CO2 or carbon emissions into the environment, into the atmosphere. What happens next? There's also a temperature signal, you know, a temperature delta for global surface average temperatures. And I really want you to hang on to that global, right, average, right? And that's what it is. And we've got a better understanding of that. But then when it then gets extrapolated or downscaled into individual regions, into the extremes. Because when you're looking at floods, average temperatures or average rainfall isn't going to help you very much, rather than extreme rainfalls, or you're looking at the very high percentiles, right? So that's where the model uncertainty is, because there are inherent limitations to global climate models and even regional climate models to be able to downscale that to a granularity that is fit for purpose, for assessing, for example, the flood example, which is acute physical risk, right? And then later on, you then tack on, you know, internal variability. So for example, why do we look at, you know, horizons that are 20, 30, or even, you know, up to 2100? That's because if you look at just a few years into the future, that's probably dominated more by natural climate variability, of which Australia has the highest natural climate variability anywhere in the world. So things like El Nino sudden oscillation, ENSO cycles, or even Indian Ocean dipoles and the likes, right? So a fun fact is this year, globally, we might already be, you know, overshooting that 1.5 degrees Celsius global surface average temperature mark, just because we're in a, you know, we may go into a very likely situation of a strong El Nino following 3 La Niñas. Right? But just to finish that up, I think I do agree with you, Graham, in terms of the uncertainty shouldn't be inhibiting us from exploratory efforts to better, you know, appreciate that uncertainty when we're making decisions or making, you know, portfolio monitoring, for example, to be able to understand the materiality, the feasibility, and applying precautionary principles where appropriate. So I definitely agree with you on that one.
And perhaps this is a good chance to step into an organisation rather than focusing on the external part. But Mark, what would you therefore see as biggest challenges or limitations for banks when trying to implement climate change scenario analysis?
Yeah, so both Graham and Alex have obviously spoken about uncertainty, and I'm sorry, I'm probably going to double down on that a little bit. I've spent most of my time in sort of the analytical areas of banks, and all I really want is good data. And it's good data to put into models like the ones that Alex talks of. So I'm afraid it sounds a bit pessimistic, really. We're saying that we've got uncertainty on models and we've got uncertainty on the data that goes into that models. But the thing about having good data is that you can analyse it over time and you can use it to build better models and forecasts. Paul had mentioned, where we think we are on this journey, and we're certainly nearer to the beginning than nearer to the end. So the quicker that we can improve our data, the quicker that we can get a really good handle on what the end part of that journey looks like. So one of the key challenges that I've seen so far is really getting a clear understanding on simple areas. And I'll give a couple of examples, one on industry and one on postcode, really simple things that we should see every single day. So there are always customers that transcend industries, right? So let's just think of Uber. Do you classify them as a tech firm? Are they a taxi service? Or are they people that bring me Korean fried chicken? Who knows? So fitting such customers into a model becomes really difficult because each of those industries has different risks and can be affected by transition risk in a different way. So we need to make sure that we collect the data in a way that can be clearly understood so that we can pipe it into the correct model and not get unintended consequences or insights that take us down the wrong path. Paul had touched on it briefly, but another challenge is projecting so far into the future. One, it's difficult for us to understand what 2100 looks like. But two, there's all the things that could emerge. So there will be sectors that we don't have today. There will be different data classifications that we don't have today. Yet we're being asked to think about a world in which they might be a really key point. And that's incredibly difficult for humans to do. We're not wired to do that. We're good to deal with the here and now and sometimes the past, missing bits out that we have selective memory loss on. But this creates opportunities for us, right? There's going to be new data that's going to come in. There's going to be new experts that are going to be sitting up here. There's going to be different ways to derive new insights and to give them to customers, people of Australia, so that we can actually help them through their challenges and through their industry as well. We have to balance this, though. It's all well and good me sitting here saying, look, we're going to get loads of awesome data. It's going to be wonderful. But I'm pretty sure everyone in this room is a customer of a bank. And I'm pretty sure you all get really excited when that bank sends you a huge form to complete. And that, in essence, is what we're asking. We need more data to be able to drive new models. So we really have to balance this carefully between what our customers actually need, what value we can get out of it, and what, in essence, is an analytical exercise. I said I'd talk about postcodes. So I'll just jump onto that briefly, and it's kind of going a bit more towards physical risk. But that geospatial data is really important in any climate scenario analysis, and it's that granularity as well. I think one of the things that we would have seen, going back through kind of the history of banking records is, core data elements like postcodes can be collected on a head office, or they could be a largest corporate site. And again, you put them into models and all of a sudden you're not finding out much about postcodes that are 2,000, 3,000 or 5,000. But there might actually be multiple property locations under that postcode. They could be farms, they could be shops, they could be factories, which have very different postcodes and very different climate risk profiles. So we've always collected postcode, but what we need to do is do it in a better way, understand what it's being used for, so that we can actually drive the models that we're building in a better manner. And that will actually help get more reliable insights. That will actually mean that we can increase the speed of the journey that we're on, and that we can actually provide to our customers, far better value as an industry.
Thanks, Mark. Paul, I've asked about the as-is state. I'm going to ask a similar question, but what would you see as the future direction of climate scenario analysis? Again, focusing internationally and then domestically.
Okay, I'm going to touch on two areas: the scenarios themselves, and then a broader from a framework design. So the scenarios themselves has been touched upon, right? The data is critical, but what's also critical was common themes this morning: collaboration, right? So once we understand across those scenarios where we sit, whether that's an exposure number, a loss number, whatever that is, we also need to understand from a bank perspective, given where we're trying to risk manage the bank's collateral, is a level of insurance as well across our customers, because that level of insurance will dictate what the level of risk is for the bank. And in order to do that, we need really good collaboration with insurers, both to understand if our customers are insured, what level of insurance they actually have today. And then secondly as well, insurers reprice every annually, right? But we lend out past that. So understanding as well the likelihood of insurance for our customers will be critical, right? In being able to risk manage that collateral a lot better from a banking perspective. And additionally as well is the strong collaboration at the local, state and federal level, okay, with understanding the resilience programs that are being rolled out and getting data across that as well. Because you may not be able to get insurance or very little insurance, but from a physical perspective, you could be in an area that's taken advantage of a lot of governmental resilience programs that's been put there as well. So we need to be able to capture that. So think of an exposure number and then think of a mitigated number, right, as at the end of the day. That's really important. Another area is a lot of these numbers that we create on the outputs are very much first order risks. We also need to extend now into second order risks as well. So I'll give you an example of that. So you could have a transition that's going on in a higher emitted sector. And let's say Australia's very renowned coal mine shutting down, right? So we know that's going to have an impact on our corporate clients. But what we also know is that those mines hire a lot of kind of retail clients and they take out mortgages as well, okay? So there is that feedback loop and understanding as well. What's the impact when coal mines shut down, right? And what jobs go? And then there are communities around that, there are businesses and so forth. That also needs to be captured. And then there's also then the feedback loop, okay? Where when we know what the transition looks like, banks potentially could have a herd mentality, right, where they start curtailing lending at the same time in the same sectors. And that will have ramifications. It could compound losses and it could impact the bank even further as a result. So it's really important to understand that. And I think thirdly as well, a lot of this stuff is very much then climate focused. We need to then bring in the economic elements as well. Because climate change doesn't land when things are great, right? It could also land when things are really bad. So you can imagine a situation where, you know, we're coming into a really bad downturn, unemployment is high, insurance are curtailing, they're not coverage as much. We get a physical event and people aren't covered, right? At the end of the day then, what we end up happening is then a lot of people are going to be drawing upon that money that they weren't additionally covered. And that's what brings me on to the next risk. A lot of this has been around credit risk. So on the panel this morning, especially on the regulatory panel, it was talking about climate risk being a new type of risk. It is, but it's also a transverse risk, right? So that transverse risk is credit risk, market risk, liquidity risk, operational risk. So a lot of the scenario analysis to date has very much been around from a lending portfolio, i.e. a credit risk. But what also concerns me is the other elements, such as market risk, sudden repricing of securities, liquidity and funding risk for the bank as well, which will also need to be captured because we're already seeing funding go up. You know, people viewing Australia, you know, as a high risk area. Or as another example is if our customers, i.e. our deposit holders, are not insured to the right level and they get impacted, what are they going to do? They're going to draw upon their deposits, aren't they, to fund the damage. And what that could potentially mean is you could have liquidity issues around that. Now, it's important to highlight as well that these risks I'm talking about here are still very early on, so we haven't had research nowhere near as much as we are for credit risk. So empirical research around these areas are very, very low. but they are potentially plausible situations that I think that we need to capture as well going forward within our scenario analysis.
Thanks, Paul. And I think we probably only have time for one more question, a very quick response, if you will, and I'll ask it to Graham in terms of what do you see as the future for APRA and climate scenario analysis?
So we are, John Lonsdale alluded to this morning, we're currently scoping out a new quantitative assessment, climate scenario analysis style approach, building on what we did with the banks through the climate vulnerability assessment, but this time in insurance. So it goes very much to Paul's comments there around that linkage with insurance. Looking, however, at the prevalence of access and affordability challenges within insurance and how that might evolve into the future. We're thinking out to 2050. And it has all the challenges of uncertainty and modelling, and it's not just postcodes, it's address level in certain circumstances, because flood can be one side of the street and not the other. But that's the area that we're thinking about at the moment.
Thank you. And please join me in thanking the panellists for their time today.
Thanks very much.